August 3, 2026, closed as a session of extreme volatility and conflicting signals that left the tape looking nearly impossible to read. The Dow opened green, dropped 200 points intraday, then reversed to climb 300 points by the close. This mechanical shakeout triggers retail panic, allowing institutions to buy the floor. But recovery wasn't universal. Crude oil detached and cratered 7% in hours. At the same time, the pharmaceutical sector saw a massive divergence. One of the industry's most successful giants saw its valuation collapse, while its primary rival experienced a sudden vertical surge. There is a significant disconnect between the flashing numbers on the public exchange and the private rooms where these assets are actually valued. Understanding the logic of today's tape requires following the capital through 4 specific deals, executed in the shadows while the rest of the market was reacting to the noise. The first shift happened over the weekend when the president abruptly canceled a WW2-scale military strike on Iran that had been scheduled for Saturday night. While the official statement focused on the human cost, the move followed a series of private calls from Saudi Arabia, the UAE, and Qatar. These allies successfully lobbied the White House to prioritize a 60-day diplomatic free passage agreement over direct military engagement. This satellite perspective shows the Strait of Hormuz, the narrow geography through which AstraZeneca is reportedly in advanced private merger talks to acquire Bristol-Myers Squibb. Usually, an acquisition drives the target company up while the buyer takes a minor hit, but today, AstraZeneca shares plummeted over 7%. This reaction is a result of the scale of the math. AstraZeneca is valued at $264 billion, while Bristol-Myers sits at roughly $133 billion. To reach the rumored $400 billion deal value, AstraZeneca is being forced to pay a massive premium. The smart money is currently punishing the stock for valuation risk, signaling that AstraZeneca is overpaying just to engineer their 2030 growth targets. Whether the subject is a military standoff in a shipping lane or a corporate takeover in a boardroom, the final market price is dictated by the underlying math of the negotiation. That same focus on private intervention shifted into the currency markets today, as the Japanese yen experienced a massive, sudden spike to a 3-month high. This move was driven by a coordinated $10 billion intervention by the US and Japan. This marks their first joint effort to manipulate currency prices in 15 years, a move designed to stabilize the yen at all costs. A stronger yen generally creates a weaker US dollar on the global stage. This provides an immediate tailwind for raw commodities and gold, which are priced in dollars, as well as emerging market stocks. While central banks were working together on currency, the Federal Reserve was revealing deep internal fractures. Last week, the Fed officially kept interest rates unchanged at 3.5% to 3.75%. The official statement suggested a consensus pause. However, inflation has now remained above the Fed's target for 5 consecutive years, and that consensus is beginning to break. Behind the scenes, 3 regional Fed presidents, Hammack, Kashkari, and Logan, officially dissented. They broke ranks to vote for an immediate 25 basis point rate hike. This is the most significant hawkish dissent since 2016. It signals that even within the most powerful financial institution in the world, the plan is no longer unified. Institutional unity is currently a surface-level illusion. Central banks are actively maneuvering against global currencies while fighting internal battles over how to control the flow of capital. Today's price action demonstrates that public market moves are the lagging indicators of private agreements in geopolitics, corporate boardrooms, and central banks. The next catalyst to force these hidden variables into the open arrives this Friday, August 7th. The July non-farm payrolls report is expected to show an addition of 91,000 jobs. That number is the hinge for the entire market. In June, the economy added just 57,000 jobs, a massive miss that put the Fed on the defensive. If Friday's print is over 100,000 jobs, dissenters demand a September rate hike, bond yields rise, and stocks take a hit. However, a weak print under 70,000 forces the Fed to pivot, creating a bullish environment for equities. While the general public waits for the headline on Friday morning, the institutional players have already mapped out these thresholds, and now you can trade right alongside them. Trade smart.